The E-mini has a big gap up. We had a 4-day pullback from a parabolic wedge buy climax, and traders were deciding if the pullback had begun or we would get one more leg up. And I said these two bull bars made it slightly more likely that we would get one more leg up. In addition, we have that magnet of the top of the crash just above. So it looks like today might be the start of a test up to that crash high. The problem the bears have is, the problem the bulls have is 3 bear bars. It's a weak buy signal bar. For the bulls, it's a high one bull flag, a pullback, and a bull trend. I think, as I've been saying, the next couple of weeks will be sideways to down, but we might get one more new high first. We may go above this high and maybe a little bit above that high, and then begin a correction down maybe to the February low, possibly all the way down here, less likely all the way down here. Whenever you have these big gaps, there's only a 20% chance of a trend from the open, either that lasts all day. So 20% chance we just sell off all day or rally all day. There's an 80% chance that we'll get at least one reversal. Typically, the most common thing is that you get basically a trading range for the first hour, and one of 4 things is likely. You either get a pullback and a double bottom, or you get a sell-off to a wedge bottom near the moving average, and then a bull trend, or you get a double top or a wedge top and then a sell-off. So the bears need a double top or a wedge top, bulls need a double bottom or a wedge bottom, and the bottoms typically reverse up around the moving average. 20% chance we just get a strong trend from the open. If the bar closes on its low, it's a reasonable swing sell. There would be about a 30% chance this would be the high for the entire day. But that's unusual, so it's more likely that there's going to be something wrong with the bear case, like a tail on the bottom that's fairly conspicuous. One problem the bulls have is, here's the average price. Are there a lot of bulls willing to pay this much above the average price? The bulls will buy above average if the price action is far above average. However, if it's a bear bar, that is not far above average bullishness, and bulls will not want to buy up here. And the result is the market will have to come down to find a price where bulls will buy. We still have 2 minutes left of the bar. It's a bear bar right now, but it could be a bull bar when it closes. The Globex high came right at the end of the Globex session. 90% chance we're either going above the Globex high or below the Globex low. Since we're right near the Globex high, it's more likely that we're going to go above the Globex high early in the day. We have a spike pullback channel. So there's a magnet here, which is around yesterday's high. So for the bears, they're trying to get the bar to close on its low. And for them, it's a swing short, taking a chance it's the high of the day. But 80% chance we're basically going to go sideways for the first hour, hour and a half. Now, what about bears selling below 1? Well, they'll be risking 6 points, 5 points. So if their account can handle the risk, they can do it. It's a higher probability bet to wait for consecutive bear bars, 2 bear bars, before selling. Bar 1 is probably going to have a bear body, and that is a problem for the bulls. It'll make a lot of bulls unwilling to buy above 2, even if 2 is a bull bar. You know, this weakens the early bullishness, and it makes traders hesitant to pay that much more than the average price. All right, so there's a tail on the bottom of the bar, probably enough of a tail to discourage a lot of bears from selling. So we may go sideways for a few bars here. And it's a big enough bear bar so that bulls are not going to want to buy above 2. So most traders are better off doing nothing here. Can you buy the low of 1, arguing that the tail makes it a weak sell? Some bulls will do that. I have 2 red lines here. TradeStation put in a new feature here. So one is the gap above the high from a couple of days ago. I think I'm going to get rid of that. I think TradeStation did not fix the problem with the lines. See, I'm deleting the line, and it's removing other trend lines. So I just removed other trend lines that I did not want to remove. For example, it looks like I removed that trend line. It really is annoying that TradeStation cannot fix this. And we also removed that trend line as well. Anyway, so for the bulls, bull trend, bull flag, trying to get trend resumption up. And for the bears, they want the lower high major trend reversal. We put it back to the 5-minute chart, 60-minute chart. Trading range, buy climax, and then a sell off. Does not look all that bearish. We did not get big consecutive bear bars. And then the rally began here, did not look all that bullish. The bulls are hoping that it becomes bullish here, that we get a big bull bar on the 60-minute chart. But we're still in a trading range, and the bears are hoping for a lower high major trend reversal. So bull trend, bear breakout, strong minor reversal, and they're hoping this is just a test of that, and that we form some kind of a double top, a lower high double top, a higher high double top, but some kind of a double top, and then a trend down. What happens if 2 closes with a small bear body? Well, we probably would be always in short, but unless it closes on its low with a pretty good bear body, a lot of the bears will wait. Yesterday's high, we have a gap. And gaps I usually highlight with magenta pink. Very often the market tests the gap, tests yesterday's high. When you have a small gap, we have a big gap today, but when you have a small gap, the gap usually closes in the first few bars. But a big gap like this, the bulls have a better chance of keeping the gap open. On the daily chart, we had a gap up and then a gap down, so an island top. And now we have a gap down and a gap up, so an island bottom. Island tops and island bottoms are fairly common and are not important. They're minor reversals. Here's an island bottom. We rallied for 4 days, and then we sold off. Here we have an island top, sold off for just a few days, and then went back up. Another island top, 4-day pullback, and then rallied. 1-day island bottom. Because of that tail on the bottom of 1, a lot of bears are hesitant to sell. They're concerned that it's a sign that the bears are not as strong and relentless as they could be. And for the bulls, nobody wants to buy above 2 because of that big bear bar, bar 1. So we're probably going to be mostly sideways to down over the first hour. And if we do rally, as I said, we'll probably get a wedge top or some kind of a double top and go sideways to down to the moving average. This bar is almost complete, and it's not a bull bar. So again, this is not bullish enough to make a lot of bulls buy above 2. You see in the final seconds how it ended up with a one-tick bull body. So the bulls did the absolute minimum. They avoided a bear body, which would have made traders more willing to sell below 2, below 1. So right now, a high 1 bull flag after a gap up, but a weak buy signal bar and a big bear bar, bar 1. So probably sellers above 2 and above 1. Remember, we're right below the Globex low, so we may have to assume we're right below the Globex high. So we may go up a little more before we pull back. So we may go above the high of 1 to go above the Globex high, but probably sellers not far above the high of 1. What happens if 3 closes on its high, 4 closes on its high? Well, then you have to be thinking that maybe it will be a trend from the open, bull trend. But remember, trends from the open, bull trends or bear trends from the open, happen only 20% of the time. 80% of the time, any strong trend on the open, up or down, after a big gap, will lead to a trading range, a double bottom, a double top, a wedge bottom, some kind of sideways pattern. Limit order start. The bulls bought below 1 because it did not close on its low, and the bears sold above 2 because it's a weak buy signal bar and there's a big gap up and a big bear bar. You can see every bar here replaces a bar 20 bars earlier, so the average price is going up quickly. You can see the average rising quickly. Are we always in long or short? It's, I think, more bearish than bullish over the next few bars because of 1, but why were the bears unable to get a bear bar on 2, and therefore I don't want to think of it as always in long or short yet. Bulls unable to rally above the high 1 bar 2. They're going to try to get a high 2 bull flag above 4. Globex chart. Pull back to the moving average. The bears have a double top. I never look at the 5-minute Globex chart. I can see the 15-minute here, and I know right now the odds are we'll probably go above the Globex high at some point today, but I'm not placing trades based on that. If the bulls get a bull bar closing on its high, bar 4, it would be a reasonable buy, but it probably will turn into a scalp. In other words, we'll probably go above the high of 1 and then not go much higher. You can see the market is waiting. There's no urgency. There's no sense that the price is terribly wrong. Today's Friday, so weekly support and resistance are important. And the week's high, the week's low, last week's high, and the weekly moving average are all nearby. Unlikely that we'll get all the way down to the week's low, and that means the open of the week is important. Why the open of the week? Because if today closes above the open of the week, the bar on the weekly chart will have a bull body, and that would be more bullish. Here's the open of the week, right there, just above the high. So the bulls would like today to close above that blue line. Not a great buy above 3, but we have 2 magnets above the Globex high of 3, the high of the day, the Globex high, and the open of the week. If you're paying far above the average price, you have to be buying something that's worth much more than average. A bear bar and 2 dojis, is that far more bullish than average? No. So this is not a great buy yet. the bulls need to do something to attract buyers. They need to start to get bull bars closing on their highs. Can you buy above 4 if it closes on its high? It would therefore be a reversal of much of 1. It's still, okay, so now we have 2 bull bars, but both with tails and a big bear bar. We have magnets above. However, this is not very bullish. It still could be the low of the day, right? 3 could remain the low of the day. You can see how it popped above 1, running the stops on the bears, also going above the Globex high. Back to the open of the week, important price. The bears would like the week to have a bear body, reduce the bullishness of the weekly chart, and the bulls would like not only a bull body, but they'd like this week to close above last week's high and far above the weekly moving average. And bulls would like the week to close above last week's high up here and above that December 12th top of the crash. I think that's an important magnet, and I think we're going to get there whether or not we sell off first, but I think we're going to get above that crash high. You can see big bear bar, so some sellers above bar 1, and on the 15-minute chart, it's a high 1 bull flag on the 15-minute Globex chart. It's a high 2, actually, high 1, high 2, but a big bear bar. So probably you'd expect some limit order bears selling above that 15-minute bear bar. Now, we broke above yesterday's high and reversed down below bar 1. The reversal failed. We're trying to resume up again above yesterday's high. If we get a second reversal down below 5, below 6, that would be a higher probability sell. But the bears want a bear bar closing on its low or near its low. So gap up, reverse down first time? No. Reverse down a second time, traders will start selling below bars. Gap up, first sell, second sell, like a double top. Gap up, first reversal, second reversal. Better to sell below bear bars closing near their lows. First big gap up, first reversal, no. Second failed breakout of yesterday's high. Traders start to sell below bear bars, hoping for a swing down. Bulls want a bull trend from the open, and they're trying to change the quality of the rally. They're trying to make it stronger. They're trying to get bull bars closing on or near their highs. This bar is making it always in long, consecutive bull bars, with one of them having a good sized body closing near its high. So if this bar looks like this when it closes, then we would be in the early stages of a bull trend from the open. Probability, right? It's less because of this, and risk is big because your stop is down here. So not a very strong buy. Most traders, it's probably not worth it for most traders to take this buy. You don't want to be risking $400 a contract this early in the day when the probability is not very, very high. And it's not. These first 3 bars, first 4 bars, that tail on top, those are all problems for the bulls. You know, to be paying this much above the average price, this is not far above average in terms of the quality of the buying. Limit order bears who sold above 1 made money. They sell the 1 high, they sell more 1 point higher, and then they scalp out when it comes back to the 1 high. Some bears will hold, hoping that this is the high of the day, a small double top, but that bull body, most bears are not going to sell below 5. They'll wait to see if 6 closes on its low and then sell below 6. Like in these examples, you know, traders are not going to sell below that bull bar. They're more willing to sell below a bear bar closing near its low. Gap up, first reversal, no. Second one, yes, but traders don't want to sell below below bull bar or doji bar, they wait for bear bars closing near their lows. That would be a sign of stronger selling. Can you sell right here? Obviously, this could end up being the high of the day. But I think in general, it's better to sell below bear bars closing near their lows. Will bulls buy the 5 low? I would not. Show me, here we have 5 bars, 6 bars. Show me a single big bull bar closing on its high. There are none. And, therefore I'm hesitant to buy with a limit order too high up. Important bar 6. The bears want the bar to close on its low. If they get it, it would be a credible sell setup for a swing down. And the bulls want anything other than a bear bar closing on its low or near its low. They're hoping that this is the start of a small pullback bull trend. What's more likely? I said on the open, 80% chance we're going to get basically a trading range for the first hour. And then some kind of a double bottom or wedge bottom or double top or wedge top. Bulls, a high 1, a pullback from the breakout above the high of the day and above the open of the week. But swing buy only, the probabilities are not very good. Might get a small wedge, 1, 2, and then one more push up, 3, like yesterday. I talked about that yesterday. The rally, the high 1 above 11 might be the third leg up in a wedge, 1, 2, 3. The market's deciding, is this an early high of the day or an early low of the day? And the bulls need to do more. So far, not all that good for the bulls. They have one good bull bar, bar 6, but it's also possibly the start of a third leg up. We reversed down below the open of the week on bar 1, again on bar 5. So buying above bar 6 is certainly an okay swing buy, but the bulls need to start to get bars closing on their highs. They have 1 with bar 6. Well, most of the bulls scalp. The bulls have bought 6. Buying these highs, like bar 6, a lot of times you don't know where the high of the bar will be until the final second. So if you're trying to buy above the high of the bar, you got to be very quick to place the order. The alternative is simply to buy the close. As soon as you see 6 close near its high, you just hit buy the market. Bears want a wedge. So low 1, low 2, low 3, but they need a decent bear bar. Bulls hoping this is the start of a bull trend from the open. Gap up, big gap up, bear bar, dojis, and then we started to get some bull bars closing near their highs, and traders buy above those highs. And this is what can happen. That's unusual, but that's what the bulls are hoping will happen. Another example, gap up, weak start to the day, but when you start to get bars closing near their highs, it's decent buying. Here, big gap up and 2 big bull bars. The bears kept trying to reverse, but bulls kept buying above bull bars closing near their highs. Yesterday we had a wedge open. That does increase the chance of a wedge open today. The market tends to repeat behaviors. And sometimes it's like it gets in a certain mood, and you'll get a lot of wedge tops or double tops or expanding triangle tops or ledges, or a lot of times the market will just start to do some kind of a pattern, and a pattern that you don't see all that much, and then all of a sudden you see it several days in a row. To sell below 7, the bears need a bear bar closing on or near its low. We already know today's not going to be a big bear trend day. 6 bars, only 1 bear bar. So that reduces the chances that today will be a big bear trend day. So that leaves us with a trading range or a bull trend day, or possibly a weak bear trend day. The bulls have owned now 5 bars, maybe 6 consecutive bars. So that means the bulls are fairly relentless, and that reduces the chances that the bears will be able to create a big bear trend. The more bars closing near their highs that we get, the more likely this will be a big bull trend. Right now, I think the odds are against it. Look at the daily chart. We got 3 bear bars. Not a good buy, not much buying pressure, so not a good buy setup. But right now, bulls are getting bars closing on their highs, 6 and maybe 7. They really need a couple more bars here to eliminate the possibility of a wedge with 1 and 5. Still buy the close, but if 8 is a bear bar closing near its low, it's a reasonable short. Even though a bear trend is unlikely, we could sell off over the next 5 or 6 bars and form a double bottom with 3, and that would be around the moving average. Big gap up, early rally, strong sell-off to around the moving average, and then we have a bull bar. It's a higher low double bottom, but it's a double bottom. This is a test of that and of the moving average. Strong rally, very strong sell-off, but basically a double bottom. This is not a gap up, but it's the same idea, early rally, double bottom. Gap up, strong sell-off. Look at these bear bars, but support at the moving average. Traders start to buy above bull bars closing near their highs. When you get these trading range opens, usually the day is not a strong bull trend day. It usually ends up with a lot of trading range trading. Okay, this is better. Strong, big gap up, strong rally, strong sell-off, and then a double bottom. Again, when you have that much selling, the day is probably not going to be a huge bull trend day. It'll probably have a lot of sideways trading. Big gap up, double bottom. Double bottom here, maybe double bottom here, double bottom bull flag here. Small double bottom, and then rally. Is this a double bottom? I really would call this more of a triangle. Small double bottom after a big gap up. A couple bear bars. The bears tried to get a wedge. Instead, we got a breakout. This changed the character of the day. A surprise bar. I did buy on a stop above 6. I did not buy on a stop above 7. 7 has that tail, and the bar is not all that big, so it makes me think we might be trying to form a wedge. Good buy the close rally. Will traders sell below 8 or 9 for a wedge? With 5 consecutive bull bars, probably buyers below 8 despite the wedge. What about a parabolic wedge top? It could be, but I think the bears need a bear body. Do I think it's going to be a trend from the open bull trend? No. But right now it is. Strong bull trends that last all day are uncommon. It's still buy the close buy for any reason. First reversal down probably will not get far. The bears can hope for this, a gap up and a parabolic wedge. So very strong trend, but you need, here we go, series of bull bars, pause, big bull bar, small bull bars, pause, third, and then we got reversal down. Here, high, pause, 3, 4, 5 pushes up depending on how you count. Not a very good shape for a parabolic wedge. Down, 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 parabolic wedge. But this is a very tight bull channel with a series of decent bull bars. Most bears will not sell below 10. 60-minute bulls trying to get a good first hour. They're trying to get a big bull bar closing on its high, increasing the chances that we go above the high from 2 weeks ago. Open of the week, I think, is probably going to be the biggest magnet all day. Obviously, if we go up 15, 20 points from here, we're not going to come down to the open of the week. But right now, look at the weekly chart. We're still very close to the open of the week and last week's high and the 20-week moving average. So we're at a cluster of resistance areas or magnets, whatever you want to call them. Any reversal down can be the high of the day. But with 4 consecutive bull bars closing near their highs, I think the bears will need a micro double top or a second sell signal, and therefore not a good sell below 10. If it's a bear bar closing near a slow, I think bulls can get out, but bears need to wait for a micro double top or 2 or 3 bear bars before selling. On the open, no matter how strong a rally that you get, a 50% chance it'll reverse without a micro double top. This is less than that because of 4 bull bars closing near the highs. Also not exhaustive. It's not like the bars are very, very big. So it's not a biclimax type of open where you have big bars. And we don't have these big bars. So big, small, big, small, big, small, parabolic wedge, big gap up. We don't have these exhaustive type bars today, the big bars. So this is not an exhaustive look, and therefore it's less than 50% chance that this is the start of a big reversal down. Bulls, I'd get out below bear bar, and bears, I would wait for at least a micro double top or 2 or 3 bear bars before selling. Can you buy the 10 low? I would not. We might get a high one above 11. Getting near to the end of the first hour, this is affecting the appearance of the first 60-minute bar. Remember I said the bulls want to get bull bars closing near their highs. That will make traders more confident that we're going up to a new high, maybe 2,700. And the bears are hoping that this big gap up is just part of this trading range and that we stall up here and then get a reversal down maybe on Monday. Probably more buyers than sellers, but because of the possible wedge, a low 3 with 1 and 5, and the bear bar closing on its high, bear bar closing on its low, I think it's probably not worth buying the 10 low. I would get out of longs. Odds are we're going to go up a little bit more after 6 bull bars closing near their highs, or 5 of them closing near their highs. High 1, but consecutive bear bars. So probably sellers not far above 11 and probably above 10. So always in long, but not what the bulls want. You can see we're getting closer to the moving average. The moving average is going up faster than the price. Every one of these bars replaces one of these bars, so the average price is going up very quickly. Bulls need to wait for maybe a micro double bottom closer to the moving average. Maybe if we get a couple bull bars closing on their highs, 12, 13 bulls will start buying closes again. But the 2 bear bars, I think, will make bulls hesitate. And for the bears, they need, I think, a second sell signal. Maybe if we go above 10 and reverse down again, then bears would sell. You have buy the close bulls 9, who bought the close of 9 or bought above 9, disappointed 10, 11. What are they going to do? A lot of them bought more, a point or two lower, knowing the odds of a bear trend were small without at least a micro double top. However, they may decide that 10 and 11 are very disappointing and make it unlikely that we're going to go up much further. And therefore, you have bulls selling here. They bought the 9 close, they bought the 9 high, and they're disappointed 10 and 11, and they're deciding, maybe I should just try to get out. Maybe I'll take a 2-tick loss. So they'll place limit orders to get out around that 9 close. And that's part of what's going on here with 12. You have bulls selling, disappointed bulls. We had a buy the close market, and then we had a disappointment bar 10 and another one 11, and they're deciding, no, maybe it's not strong enough to be long at the high of the day. Maybe I should get out, take a small loss, and look to buy lower. Well, the bears micro double top 10, 12, but most bears are not going to sell below a bull bar 12. This is the end of the first hour, and so far a good bull bar. Best case for the bulls would be a couple legs down, so 12 and maybe 14 or 15, and then a bull buy signal bar for a high 2. Alternatively, if we suddenly get a surprise bar up, that would be good for the bulls, but that's not likely. The same process of buy the close and then disappointment on the 5-minute chart is also taking place on the daily chart. Very strong breakout. You have bulls buying the market, buying the close, and then they're disappointed by this, and they decide that, well, it's not all that strong. Maybe I should just try to get out around break even. So they buy up here, and then they get out around here, and you get a double top. That's how double tops form. You get disappointed bulls hoping for a bull trend. They get disappointed by the sell-off, and when the market comes back to their original buy, they sell. They sell onto their longs. The opposite is true at bottoms. Big bear breakout, bears selling, disappointed by 46, 48, 49, and they decide, if it comes down, again, I'm going to use any sell-off to buy back my shorts. And when they get that sell-off on 51, the bears buy back their shorts, and the bulls buy as well, and we get the reversal up. The bears just got stopped out, the swing bears. It was really, I think, a low probability short, so I would not have sold below 10. And the bears now need a parabolic wedge. So reversal down, and then a third reversal down. Bulls hoping for a breakout. Part of the reason why 13 popped up like that, it went above the high of the first hour. Bar 12 was the close of the first hour, and the 60-minute chart has a buy the close look to it. A big bull bar closing, or a decent bull bar closing there is high. So it's a stop entry buy. And 13 went above 10 and triggered the buy on the 60-minute chart. This would be a better sell than 10 if the bears get a decent bear bar. Micro double top, parabolic wedge, fail breakout, open of the week, fail breakout, yesterday's high. But the bears need a good bear bar. If it's not a very good bear bar, they'll wait to see if we get 2 or 3 bear bars and then start to sell, like this yesterday or like this. Once you start to get 2 or 3 bear bars, traders look at it and say, the bears seem like they're in control for a long time. Maybe we'll go lower. Bears want to get bear bars. Some will sell below any bear bar. Others prefer bear bars closing near their lows. When you have a lot of buying like that and you get a top, you often get a swing down, but most of the time you do not get a big bear trend. Sometimes you get a huge bear trend, but most of the time you end up in a trading range. So what happened? I don't care. So why did this happen? Doesn't matter to me. Testing the open of the week. You know, the open of the week determines whether or not, well, bar 81 today, the close of bar 81, the final bar of the day today, determines whether the week will have a bull body or a bear body. If it's a small bull body or a small bear body, it really doesn't matter. It's more just symbolic, kind of like bragging rights. The bulls would like the week to close with a bull body, so they want the week to close above the blue line. But if it's a small body, it really doesn't matter. You know, it's a small bar at resistance, the weekly moving average. Probably sellers not far above this week's high, if this week looks like this when it closes. What do you do? Well, it's dangerous, right? We just had an outside down bar. It closed around its middle. We now have a 5 or 6 bar tight trading range. Bulls want a bull inside bar for an IOI bull flag, and the bears want a bear inside bar for a parabolic wedge top. So reversal down, and then reversal down in search of a sell signal bar. So 14 becomes a potential buy or sell signal bar, depending on how it looks. If it closes on its low, it's a reasonable sell signal bar. If it closes on its high, it's a buy signal bar, but the bull trend is weakening. Plus, it looks like we're having a hard time breaking free from the magnet, the open of the week. We went above it, tried to get down to it, got down to it here. Increases the chances that it will be important at the end of the day. Reverse down from it on 1, reverse down from it on 5, broke above it, came down to it, touched it on 13. The market is telling us that the open of the week might be important all day. Even if we rally for the next 3 hours, 4 hours, if we're not too far above that open of the week, we may come down to it at the end of the day. Now, what do the always in bulls do? If they get out below 10 or below 11, theoretically they have to buy again if they're trading always in, and they can buy above a prior high, like bar 13, or they can wait for another bull bar closing on its high 14. However, I'm concerned that we still might be getting a wedge top. This is a potential final bull flag. 3 bear bars, big uncertain bar here, and the market's telling us it's paying a lot of attention to the open of the week. So it makes me hesitant to buy above 14, so I'm probably not going to buy above 14. Bears need a bear bar closing on its low for a possible wedge 1, 2, and 3. And the bulls is still by the close, but you can see we're getting a lot closer to the average price. However, this is a tight trading range, and buying above 14 is buying at the high of the day. So the math is not as good. It's still always in long, right? It's been always in long all day. However, if the behavior is sideways, it's usually better to buy pullbacks than to buy breakouts to a new high of the day. That red line is that high from a couple weeks ago, or from last week. Weekly chart, we have 4 strong bull bars. The bulls want to keep making new highs. They want this week to go above last week's high. However, we're right at the 20-week moving average resistance, and we only have 1 day left to the week. Even if we do get above last week's high, we're probably not going to go much above it. So it's not that important a target. So I click remove, and it removes some other trend line. I really wish the TradeStation would fix that bug. So you put the trend line back. This is the monthly chart. I'm using it to draw the trend line on the weekly chart. Okay, back to the weekly chart. Here's that trend line. And you can see it also erased the February low. Bears will sell if they get a bear bar closing on its low. Is it good enough for scalp? It might be, but it's more for a swing, looking for an early wedge top. Can you call it a parabolic wedge? Well, I would just probably call it more of a wedge. For parabolic wedge, I want to see more of these bigger bars, so we don't have that many. So when I say parabolic wedge, I'm thinking about biclimax, and this is really not climactic. So I would call it more simply a wedge top instead of a parabolic wedge top where you have these climactic bars. It doesn't matter. The idea is the same. The market went up too far, too fast. Sometimes the wedges look like that. Sometimes here. This is over 2 days. Nested, smaller wedge inside of a bigger wedge. This is more parabolic wedge. Important. The close of the bar is really important because bears are not going to sell if it does not close on or near its low. They might sell above bars, right? But most bears looking for a swing want a good sell signal bar. We know there's support here. The market sold off and bounced pretty sharply on 13. So the open of the week is support. The average price is getting near there. Buy the close, but buy the close bulls not making money. They have not made money buying above 14. They have not made money buying above 15. It went 5 ticks above 14. It had to go up 6 ticks for the bulls to make even a 1-point scalp. So here we have a bull trend, but it's difficult to make even a 1-point scalp. So not a very strong bull trend, plus a tight trading range, magnet, and possible final flag. Final seconds, will it close near its low or above the low? So swing sell, but the reality is most bears who sell below 16 probably will scalp, looking for a couple points, maybe a test of the open of the week. Bulls, I would get out below 16. You have a 5-tick trap above 14. You're trapped if you bought above 15 or if you bought the close of 15. So I would get out below 16. Possible high of the day, possible high for the next hour or two. Very often around bar 18, 16, 17, 18, 19, 20, the market tries to get a reversal. And here we have a rally and a decent sell signal bar. Here, market rallied bar 15 or so, reversed down. Rallied for the first, the blue box is the first 18 bars. You can see it reversed down around bar 16. First 16 bars, 18 bars near the high, and reversed down. So you often get a reversal around bar 18. Here, weak rally, reversed down, bar 18. But this is the kind of thing, like today. The bulls want a high one above 17, but this is not behaving all that well for the bulls. A lot of the bulls will prefer to buy closer to the average price. The moving average. Similar to the wedge yesterday. You know, we had a tail on the bottom of 14. Traders don't know, is it the high or not? Sometimes it takes a few bars before traders believe a swing down is underway. This is strong enough up, 6 through 11, 6 through 9. The count may have been reset. So this may be 1 pullback, 2 pullback, 3. And that's what the market is deciding. Is this a wedge, 1, 2, 3, or were these 6 bars strong enough to start the count over again? So this becomes 1 pullback, 2 pullback, 3. That's what is going on right now. Will we get one more new high? We could get many more new highs, but I think what's going on is what I said. This is strong enough so traders are wondering if the count started over again. Is this a new breakout? So this becomes 1 pullback, 2 pullback, 3. And nobody knows, right? So some bears sell 16 low right here and put a stop above 16. Other bears sell 16 low and then sell more if we get one more leg up. Bulls, they get out below 16. They get out here. And they're looking to buy again. And some will buy above 17 if it's a pretty good bull bar. But if it's not a pretty good bull bar, I would wait. You can see bears who sold the 10 high made money. They sold the 10 high, they sell more, 1, 2, 3 points higher. And 17 low fell 1 tick below 10 high. And that would allow bears to make money. Not a great buy signal bar for the bulls, not a great entry bar for the bears. Bulls trying to get a decent buy signal bar, and bears would like to get a third consecutive bear bar. This is strong enough. These 6 bars are strong enough for one more push up, especially with a magnet above. So the bulls have the potential for one more leg up. Will I buy above 18? I probably will not. We're getting too many bear bars, and we're still pretty far above the average price. So this is not bullish enough, not more bullish than average enough to be buying this high. Also, I think if we do go to a new high, we'll probably get a wedge. So 1, 2, and then 3. We have that magnet up high of last week. Bulls are trying to get above last week's high. Bears and bulls have not given up. The bears want the bulls to give up. They want a big bear bar reversing 14. If they get it, then we might get a couple legs sideways to down. We may even get the high of the day. Remember, the market often reverses around bar 18. The bulls want the breakout. Right now, this is bar 18. The top of the 18 bar range is bar 16. So you will have some bulls who will buy on a stop above 16 simply because it's the breakout of the 18 bar range. Swing bulls stop above 16, but they'll look to sell again if we go above 16 and reverse down. And bull scalpers, it's not a great scalp, but they'll get out above a bull bar 18. And the bulls, some bulls will buy, taking a chance that we're in a bull trend from the open that will continue all day. I would rather buy closer to the average price or above a better looking bull bar. Same process that took place here. Buy the closed bulls disappointed. And here you have buy the closed bulls 14 and 15 disappointed, 16 and 17. And some of them are trying to get out around their original buy. Either the 14 close, the 14 high, the 15 close, the 15 high. And we don't know how many we'll be giving up. the market's deciding, have we seen the high, another outside down bar like 13, and bulls still hoping that the small pullback bull trend is continuing. We still have a magnet above last week's high. So what do you see there? Okay, you just got some useful information. Do you see it? Okay, we fell 9 ticks below 16. And what does that tell you? It tells you that most of the bears are trying to scalp out with 2 points. It had to fall 10 ticks for them to get filled. It fell 9 ticks. So it tells you that a lot of bears had limit orders to buy 9 ticks down. There were a lot of buy limit orders 9 ticks down. And that means the bears are not confident of a big trend down. So weakens the bear case. And when it starts to bounce like that, what do the bears do? A lot of them quickly switch, trying to get out at 1 point. And it doesn't allow them, and then they end up getting out break even or with even a 1 or 2 tick loss. Bulls, if we get an IOI with a decent bull inside bar on 20, that would be another buy. So far, a trend from the open, bull trend, a small pullback bull trend, but bear bar 1, not good. Tight trading range, not good. The swing bears below 16 are still short. Their stop is above 16. If 19 closes on its high, will the bulls get out above 19? No, because it's so close to the 16 high, they may as well simply rely on their stop above 16. And the swing bears, it's still on that short. And for the bulls, a lot of traders are unwilling to buy. I think it's a problem. We have a 5-tick trap above 14. It went 5 ticks above 14. So here we have a pretty good bull bar 14 and another good bull bar 15. And the bulls were unable to make money on either of those bars despite a small pullback bull trend. I've taken a few scalps today, and that's it, 1 point scalps. I did sell below 16, disappointed, tail 17, bull bar 18, and I scalped out with 1 point. It's still a possible high of the day. A lot of times, high of the day or low of the day just does not look credible. And then 2 or 3 hours later, you look back and say, oh, wow, 16 was the high of the day. And so it's still on that swing sell. I'm flat right now. It's a second entry sell below 20. Well, why do we have a bull body? Tight trading range, dangerous trading for stop entry traders. Tight trading range is a limit order market. Traders sell below, buy above, and scalp. Might get a give up bar here. 21 might be the bulls giving up. They were hoping that this was strong enough to get 3 legs up, 1 pullback, 2 pullback, 3, and it looks like more and more bulls are giving up on 21. Not a lot of energy today. 20 bars, no big bars up or down. So that reduces the chances of a dramatic trend, and it increases the chances that we'll do what I said, pay a lot of attention to the open of the week, and probably not get much of a trend today. And then at the end of the day, try to gravitate back to the open of the week. If we're above it, try to get down to it. If we're below it, try to get up to it. Yesterday, the open of the day was a magnet, and today it's the open of the week. Are we always in short yet? Nope. We've been above the moving average for 21 bars. Traders have been willing to buy above the average for 21 bars. They're willing to pay above an average price. And some of those traders will be happy to be able to buy at the average price, which, as I said, would be around the open of the week, which it is now. So we got support for 13 low, the open of the week, the moving average, bottom of a developing tight trading range. So probably buyers not too far below. Not a sell the close bar. Bar is not all that big, plus a fairly conspicuous tail. We have a magnet below, open of the day. 99% of days, the market will touch the moving average at least once. So we know we're going to touch the moving average at some point today. We don't know if it's going to be soon. It looks like it'll be soon. But even in the very strongest of trend days, 99% of the time, it'll touch the moving average at least once. Bulls trying to get a high 2, high 1, 18, high 2, 22. But we're very close to the moving average. I think most bulls are not going to buy above 22 unless it's a pretty good looking bull bar. 3-4 tick body closing on its high. If they get it, I would get out of shorts. And some bulls will buy, others will wait to see if we get 2 or 3 bull bars. Tight trading range since bar 10. We have a small one here, a bigger one here, and then the whole thing is a fairly tight range. No sense that the price is terribly wrong. It looks like the market thinks the price is just about right. Here are the past 10 bars. Does it look very bullish? Well, maybe a bull flag, but not all that bullish. Does it look very bearish? No, it looks like we're reversing every 2 or 3 bars, prominent tails, small bodies. It looks like the market thinks the price is just about right. What happens if it's a 2-tick bull body closing on its high? Do you take the buy? I would wait. For me to buy above the average price, especially in light of this lack of bullishness here, I would want a pretty strong bull bar at 22. We're getting near the end of the second hour. The first hour we had a little tail on top and a body not all that big. Second hour so far, not a good follow-through bar for the bulls. Remember, you have buy the close bulls up here on the 60-minute chart and on the daily chart who are disappointed by this, and they're trying to get out around the original buy up in this area, which is where we are. So you have bulls selling here. The bulls who bought up here, disappointed here, trying to get out with without a loss or with a smaller loss. What do the swing bears do? Do they get out above 22? I'm flat right now, but if I were still short from below 16, I would get out if it had a pretty good bull bar, maybe a 3-tick bull body closing on its high, maybe 1-tick tail on top. Otherwise, I would stay short and take a chance that we're just going to keep drifting down an endless pullback. Bull trend, bull flag, maybe still a bull flag, but it just kept pulling back endlessly. So it's an endless pullback. Here, bull trend and bull flag, and it just kept pulling back endlessly, an endless pullback. And then 40% chance you'll get a breakout and follow through, and instead of a pullback, it becomes a bear trend. Is it always in short yet? I still think the bears need more. They have a lot of bare bodies, but no big bear bodies. Plus, we're still above the moving average. So I think the bears need one or two decent sized bear bars, or they're going to get a close or two below the moving average. So it's still slightly more bullish than bearish. It's on the short, below 16, possible high of the day, but the bears need to do more. Bulls want a double bottom 13 at the open of the week and the moving average, but they need a good buy signal bar. And the bears want to break below the 13 low, and then they're hoping to close the gap above yesterday's high. They're hoping that we just start to accelerate down like we did over here. Small wedge, early high of the day, wedge, possible high of the day. Here we had a wedge, and it was the high of the day as well. Bears not yet doing enough to make a lot of traders sell at the low. $20 gap bar buy. There's a gap between the low of this bar and the moving average. And we've had more than 20 bars where there's a gap below. So for more than 20 bars, bulls have been paying above the average price. Now they're finally getting an opportunity to buy at the average price. And very often you'll get buyers at the moving average. However, this is a credible top, a credible high of the day. And we're not getting bull bars for the past 8 bars. And therefore, there may not be many buyers at the moving average here. So I would not place a limit order to buy at the moving average. No buying pressure for the past 8 bars. This is bar 23. The hour closes bar 24. The hour opened with bar 13. So if bar 24 closes below the open of bar 13, the second hour will have a bear body, which is what the bears would like. And the bulls want the opposite. So they'll try to get bar 24 to close at or above the open of 13 to avoid a bear body. Becoming always in short, more and more traders are believing that this is the start of a bear trend. It's still the bottom of a trading range. So while I'm not going to buy above 23, and I'm not going to buy above 24 either, I think the bears still have to do more to convince traders that this is the start of a bear trend. I mentioned up here that I did not buy above 14 or 15, despite always in long, and I'm not selling below 22 or 23, despite the bear bars. And it looks like a trading range, and I don't want to be buying at the top. I don't want to be selling at the bottom. But there's nothing here. We had a reason to sell 16. Here we do not yet have a reason to buy. Most bulls will want at least a micro double bottom over the next few bars, so they'll wait to buy. $60-minute chart. The bar is, let's say it has a bear body. That means it'll be a sell signal bar for a double top on the 60-minute chart. And therefore, bears will want to go below the low of the current hour to see what's there. There'll be a lot of sellers below this hour's low. And therefore, if we close near the low of the hour opened with bar 13, we'll probably fall below the 13 low to see if there will be a lot of sellers on the 60-minute chart. Bar 24, multiple of 12, the end of the second hour. And even though we've sold off for 9 bars, 10 bars, not very bearish. For the bulls, double bottom, but I would not buy it. 24, not a good buy signal bar, especially in the absence of buying pressure here. 60-minute chart, It's a sell signal bar, but it's only a small bear doji, and the first hour was a small bull bar. So it does not look like the market feels the price is way too high and we got to quickly move down to a better price. It looks like the market thinks the price is probably okay. So this is not a strong 60-minute sell setup. We still might go below the last hour's low to see if there are sellers there, but there probably are not that many. When we're at this price over here, we went sideways. We may go sideways again. We're not breaking strongly above it. We're not reversing down strongly from it. So we may end up like this and like this. Looks like mostly a trading range today so far. No big bars. Not a lot of emotion. 20 gap bar bulls. It looks like there were bulls who had limit orders at the moving average, looking for at least a scalp, but not strong enough for a stop entry buy. What do the bears do? Well, they got their 4 points. I would get out. I would have gotten out. I did get out early, but if I were still short, I would get out with maybe 4 points profit and wait to see what we get. Right now, I think we're going below the low of the last hour, which is the 13 low, but I'm not sure we'll go much below it. You can see what I was saying, that the bears did not quite do enough to make it always in short. However, it's still a tight trading range for 15 bars, and even though the bulls are reversing the sell-off 21, 22, 23, bulls look to the left and say, I don't know, trading range, I want to buy low, not high. So a lot of bulls are not going to buy above 27. The bears will try to get a lower high major trend reversal, head and shoulders top, left shoulder, head, right shoulder. I wanted to buy, but I did not buy above 24, and I did not buy above 25. I was hoping for a micro double bottom or better looking bull bars. So right now I'm trapped out, still limit order market. Traders buying with limit orders below anything, below the prior bar low, below the 19 low at the moving average, a few ticks above the open of the week and the 13 low. And bears will look to sell higher. Can this still be a small pullback bull trend day? Yeah, sometimes you'll get an incredibly strong trend day that goes sideways for 2 or 3 hours before it becomes very strong. Do I think it'll happen? No. Look where we are. Daily chart, 60-minute chart. We're testing a prior high. Sometimes a small pullback bull trend will start out fairly slowly. So gap up, not much going on, but it can go up all day. Here, tight trading range, similar to today. If you start to get consecutive bull bars, then the chances are you're breaking into, consecutive bull bars breaking above our range. Then chances are you're going to get a swing. Here, basically sideways for the first half of the day, but higher low, higher low, higher low, higher high, higher high, higher high. Eventually the bull's got to break out. Similar to today, early rally and then tight trading range for a couple of hours, and then we just kept going up. The odds are against this, but I'm just showing it as an example of what might happen. It's not likely. What bulls want is a big bull bar or two closing far above the range. So the bulls want a big bull bar or two closing far above the 16 high. For the bears, they want a lower high major trend reversal, and they see 27 as simply a test of the 16 low. Remember, 16 is a possible high today, and the bears sold 1 tick below 16, and this is testing that entry price. Some bears are selling right here with a limit order, a tick or 2 or 3 below the 16 low, because the last time they sold at that price, they made money. they're taking a chance that they'll make money again. If enough do it, then we do get a lower high major trend reversal. What's most likely? Look to the left. Tight trending range for 20 bars. No clear evidence that the tight trending range is ending. Well, trading, probably more sellers than buyers, about 28, but still always in long. Is it high enough up in the range to sell? I would not do it. You can do it for a swing, taking a chance. We get the lower high, but I would not do it. For limit order scalps, you want reasonably high probability. And I'm not sure the probability is high enough unless you're willing to scale in higher. And for the bulls, I'm trapped out. The buy was above 24, and I chose not to take it. Middle of a 20-bar tight trading range. Bad environment for stop order trading. It's more limit order traders. Traders selling above things, selling more higher and scalping, and buying below things, buying more lower and scalping. Not good trading for most traders. Better to wait. Lower high major trend reversal, but 7-bar bull micro channel and the middle of a tight trading range. Not a very good stop entry swing trade. I'm flat. When you have these small bars and a tight trading range, if you're looking for stop entries, it's better just to wait. You know, we will get stop entry trades that are better than these at some point today. It's still theoretically on the short below 16, and now there's a lower high major trend reversal. But when you have a 7-bar bull micro channel, 7 bars without a pullback, it's a low probability sell, and more likely a minor reversal sideways. They bought the moving average 24. Will they buy the moving average here? We'll find out. It would be good if the bulls can get a decent bull bar, 31, 32. That would increase the chances that we're going to go higher. And for the bears, lower high major trend reversal. We have a wedge, and they're looking for 2 legs down, 1 pullback, 2. Bears made money selling below 16, and they sold again at that price. Bulls made money at the moving average, and we don't yet know if they'll buy again at that price. I want to check something with scaling. TradeStation did an update, so I'm going to do that. And then, okay, so they have not fixed it. This is not the most recent bar, so you still have to do that extra step. For the bulls, a pullback to the moving average and what they hope is a bull trend. We're still always in long, have not been always in short at any point today, but this is more neutral, sideways for 20 bars, and we're right in the middle of it. It's on a swing sell 16. I would not be short. And for the bulls, this would be a buy signal bar for a swing up. My thought about this is there's no great need to buy until it becomes much more bullish, because trading ranges resist breaking out. So it's a low probability buy above 31. I'd rather wait to see 2 or 3 bull bars closing near their highs, you know, something like this, and then start to buy closes by the market or buy with a stop above bars. Not a good buy signal bar for the bulls for a test of the moving average, and not a particularly strong entry bar for the bears for the lower high major trend reversal. Also 7-bar bull micro channel, doji sell signal bar 30, sideways more likely than down. You can see not many buyers above 31, a bad looking high 1 bull flag, so limit order bears sold above. Most traders better off just waiting. We're at the moving average support. If the bulls get a bull bar closing on its high, 34, 35, it would be a buy for a swing up. I don't think it's good enough for a scalp. You're in the middle of a tight range here, and the whole 20 bars is a very tight range. Head and shoulders top is always a triangle. So, or I think of it as a triangle at least. We have a lower high, we have a low, another low. But a possible swing buy if the bulls can get a bull bar closing on its high, maybe 34. Bull bar, but not closing near its high. So not a very strong stop entry buy, even though it's a pullback to the moving average and we're always in long and it's a triangle. You have to ask, why were the bulls not able to create a better buy signal bar? Because they were not, I would either wait for a better buy signal bar or for a pretty good bull breakout. Nobody's making much money when the market's in a tight range like this. Better just to wait for a decent buy signal bar or for a strong breakout up or down. Bulls trying, our setup is not as good as a lot of traders will want. So a lot of traders instead will wait. But I think if 35 closes on or near its high, we're always in long and it's a bull bar, so it's an okay swing buy. Stop entries in a tight trading range are not scalps. So if you're buying for a swing. If it's going to be a swing, there's no problem waiting, right? If you miss a bar or two of the trade, and it's a swing, it doesn't matter. And the trade-off is probability. The traders who wait for a second or third bull bar are looking for higher probability trades. The traders buying 35 are looking for lower risk. You know, if they buy above 35, the stop is above 35. A trader waiting for 2 to 3 more bull bars has higher probability, but the stop is further below. Is the character of the day changing? Are we switching into trend mode? The more the bulls get bars closing on their highs, and the more of the bars they get, the more likely the bull trend is resuming. So bull trend, trading range, and then the bulls are hoping for another bull trend. New high of the day, you can see how it jumped quickly up several ticks to run the stops on the bears who sold the 16 low. The bears who did not get out earlier, like above 24 or 25 or above 35, just got out. Ticks, pretty much the highest reading of certainly the past few hours. Not quite 700, but a pretty good tick reading. What about limit order bears? Selling with a limit order, 16 high, looking for at least a scalp, betting on a continuation of the trading range. Some bears are doing that, and I always pay attention to whether or not limit order bears can make money. And if they can make money, that reduces the bullishness. 36 did not close on its high, did not close above 16. It broke out of the 18-bar range, which is good for the bulls. Typically, if you break above the 18-bar range, if you break above the highest bar of the first 18 bars, only 10% chance you'll break below the bottom of the range. But since this entire range is small, and we've had so much trading range trading, instead of a 10% chance, there might be a 20% chance we get a new low of the day. Every bull bar that we get here will lower that probability. But right now, good for the bulls. You know, as I said, I don't think it ever became always in short, even with those 3 bear bars, 23. It may have felt short when I was doing that, but I said, you know, we're still above the 13 low, we're still above the moving average, and we're not getting consecutive big bear bars, and therefore still slightly more bullish than bearish. I think 36 is disappointing. The tail on top closed below the 16 high. And I also think 35 is not ideal because it's outside up. It would have been better if it was not outside up. Because it's outside up, an outside bar is a trading range type bar, totally overlapping the prior bar. So usually those are not the strongest buy signal bars. And what do we see here? Well, the bears who sold the 16 high made money. Bad for the bulls here. I did buy 36 and I scalped out. I bought it late. I did not buy in a stop above 35 because I was talking, and a lot of times if I'm talking, I feel like I cannot focus enough on the trade. But I knew it was the right thing to do, so I ended up buying. But I bought late. For the bears, they had a lower high major trend reversal 30, but 7-bar bull market channel, so minor reversal likely. Now they have a higher high major trend reversal, but it's still a small pullback bull trend. Look at the pullbacks over the past 12 bars. They're very small. So not much selling pressure. And look at the rest of the day. Look to the left. We have some bear bars, but not very big. Not much selling pressure. So not a very high probability short below 37. For the bulls, it's still always in long. They're still on the buy above 35. Stop probably below 35 or 33. However, this is not trending very well. So, as I said early on, I did not think we were going to get a big day. There's not much incentive for the bulls on the weekly chart, because to do something significant, we would have to have a huge day. We'd have to close far above the weekly moving average, 20-week moving average, and that's unlikely. So since a huge day is not likely, there's not much incentive for the bulls other than to get a bull body on the weekly chart. In other words, they just want the day to close above the open. For the bulls, 37, high 1, but top of the tide trading range, and not a very good breakout 36, tail on top, limit order bears made money. So a lot of the bulls will not buy above 37. And if it has a bear body, they're probably sellers above 37, sellers above 36. If it closes on its low, the bears have a low 230. They also have a high major trend reversal, but not enough selling pressure. And we're right above the moving average. The bulls bought here, they bought here. So I'm not going to take the short below 37. I'll wait to see if we start to get 3 or 4 bear bars and then sell lower. A lot of times I enter late because I prefer high probability. And when you get higher probability, your stop is usually further away, so you get greater risk. Whenever you take a trade that has high probability, or whenever you do anything to increase your probability, like scaling in, you're increasing your risk. The risk-reward ratio gets worse. And anytime you hear somebody on TV saying, "Oh, I'm buying because the risk-reward ratio is great," what are they telling you? They're telling you they're probably going to lose money. You see that all the time on Options Action or Fast Money on CNBC. Dan Nathan often says, "Oh, great risk reward, therefore I'm buying." But he never says, "But I'm probably going to lose money because if I have great risk reward, I have low probability." And that's true. That's always true. Whenever you have a trade with great risk reward, your probability of making money is small. I often use the lottery ticket example. You buy a lottery ticket for $1, so your risk is small. The reward is huge. You could win $100 million, so tremendous risk reward. And whenever you have tremendous risk reward, you're buying, someone's selling. They're only going to sell it if you have very little probability of winning. So that's always the case. Great risk reward, low probability, and high probability, bad risk reward. Probably the stop is far away, so the risk is great, and you're entering late, so the reward is less as well. Bull's trying to get a bull II, consecutive inside bars. That would be a high one buy. We're still always in long, but not all that bullish. You know, we're only a couple points above where we were 2.5 hours ago. Bull's trying to get a bull bar. They want an II with a good buy signal bar, so they want 38 to not only have a bull body but close near its high. And if it's not pretty much perfect, I think most bulls will not buy. And for the bears, it's a higher high major trend reversal, and they want 38 to close on its low to be a credible sell signal bar. We have a magnet above, so you can see it quickly went above the 36 high in the final second, how the bar suddenly closed on its high. A lot of times that happens, and I'm always suspicious when that happens, because it makes me think the computers are trying to trap bulls into making a quick decision and buying too high. I did not buy above 36 because of that reason, that whenever it's a crummy bar and then in the final second it becomes a good bar closing on its high like that, and the context is not particularly good, I always wonder if it's a trap. So I did not buy it. I'm flat. It's still a buy, but I'm flat. Let me just put up a small chart, like a 10-second chart or something. I don't know if I can do it. I'll put a 15-second chart. And you can see in the final seconds of the bar, okay, final seconds of the bar suddenly jumped up. And then the very next bar, this black bar is the first bar of the next 5-minute bar. It triggered the buy and trapped traders. Now, bears have a micro double top, a higher high major trend reversal, but we have not gone below a bear bar. 35 is a bear bar, but it has, 37 is a bear bar, but it has a big tail, and therefore it's not a particularly good sell. So the sell signal bar for the bears is the current bar, 39. However, it's right above the moving average. The bulls bought the moving average, they bought the moving average. So not particularly good looking setup. We're still always in long, small pullback bull trend, and location is terrible, right above the moving average. So right now I'm trapped out. Can you buy the 38 low? I'm not going to, but we're still always in long, and it's near support, the moving average. So I'm not opposed to doing it. I just would not do it, especially after the bulls just got trapped above 38. So right now I'm back to waiting. Sorry about that. I had to step away and ended up missing the short. I would have sold it as it was falling. I'm on hold with TradeStation. For the bulls, it's still the bottom of a trading range, but the sell-off is strong enough so that most bulls will want a micro double bottom before buying. There probably are sellers somewhere above. We broke below the trading range. We broke below the moving average. So there are probably sellers around the moving average and around a 50% pullback. Open of the week, magnet, probably will be a magnet all day. I am not buying above 42. Chances are we've seen the high of the day and the low of the day. A lot of times when you get a higher high major trend reversal, you then get a lower high major trend reversal. Tail 40, tail 41, bottom of a trading range. Do I think we're going to get a big bear trend? I don't think so. Look where we've been for the past 30 bars, right, in a pretty tight range. But the reversal down is strong enough so that we're probably not going above the high of the day, or at least not for until the end of the day. The bulls might be able to get there up to last week's high at the end of the day, but right now it's more likely that this is going to be a lower high. The bears are hoping for a bear trend. For example, daily chart, they want to get a bear bar closing on its low, setting up a small double top sell for next week. What do the bulls need to buy here? I would wait. Obviously, if we get a huge bull bar closing far above the average price, then we're back to always in long, but we probably went always in short 40. For the bears, it's reasonable to get out above 42. They don't have to. They could keep a stop up here and take a chance. But I think you're at the bottom of a trading range and you're getting a reversal up, possibly two legs down, 37 and 41. I would get out. Also, had I shorted, but I didn't, I would have scalped. I'm on hold with TradeStation. I thought the middle of the day would be a good time to speak with them because the market is often quiet. And I ended up missing a decent short. Right now I'm trapped out. I'm always suspicious whenever the day has a lot of trading range trading. And the market is always doing things to make you buy at the top and sell at the bottom. And it's usually the wrong thing because trading ranges tend to resist breaking out. For the bears, this is a low on short, below the moving average, but a doji bar and a bull bar 42 back in the trading range. So not good enough for me to sell. I'll wait for a second entry sell. I would feel better if 40 closed on its low below the bottom of the range and 41 closed on or near its low, but that's not what we have. That would have been clearly bearish. But I think nothing is going to be clear today. Just look to the left, right? And we're just spending I said early on that we may spend a lot of time around the open, and that's what we're doing. We're a little bit above it. I suspect we're going to go below it and then end up coming back to it at the end of the day, which is the end of the week. Always in short, but I would wait for a second sell, like maybe a micro double top or a low two bear flag. And I'm not buying the 43 low. The market just became always in short 40, and I typically do not look to buy within a few bars of it becoming always in short. Too much risk of the bears getting at least another leg sideways to down. Lower high major trend reversal. The bears would like 49 to close on its low and at or below the moving average. Might get a third leg up, 1 pullback, 2 pullback, 3, but it's a swing sell. For the bulls, not a very good buy. Do I think we're going to get a big sell-off? No, but we're going to get down to the low of the day. This is another one of those days where we have a magnet in the middle of the day. A lot of times it'll end up in the middle. So we may trade down here, but I think the day is going to end up finishing around the open of the week. So for the bears, swing short below 49, not high enough probability for a scalp. I think not a very good short. You're in the middle of a trading range. Traders are deciding whether to get a swing short out of this. Well, look to the left, the past 40 bars, tight trading range. I think it's not a very strong short. The issue is probability. I've been on the phone for all of this with TradeStation. Every month or so, I take some time out to call them and try to explain to them the problems. There's the obvious resizing problem. So if I take this window, enlarge it, that's where I am. If I scroll it over here and then scroll it back, so the most recent bar is here, and then I resize it back again, that's not the most recent bar. I have to use the scroll bar again to get it. So that, the trend line problem, And also there's some other things as well, some other issues. And then I also I've told them for years they should get an undo and a redo button. So you can just click, and put trend lines back if they're deleted. And then now they have this new feature here. They used to have background dragging. I could hold the left button down and drag it, and now I do that, but I'm off the screen and I cannot drag it back down. So I wish they would bring back background dragging. Anyway, it's still always in short, but nobody cares. All right, we're in the middle of a 40-bar tight trading range, and it's mostly limit order trading. Traders buying below bars, traders selling above, and scalping. For the bulls to get it back to always and long, they need a big bull bar to reverse this. Maybe they have a 40% chance of getting it. And for the bears, you have a lot of time to take the sell, right? 49, you've had 5 minutes, you have more time now. So a lot of opportunity to sell. And the reason why not a lot of traders are selling is because they know the math is not very good. We're probably not going to go very far, so the reward is not big. The risk is relatively big compared to the reward, and you're taking a trade in the bottom half you're selling in the bottom half of a tight trading range. Even if we're always in short, it's not very good. It's like buying above 30. I said I did not buy above 30 because it's at the top of a tight trading range, and we had not clearly broken strongly above the top of the range. And the opposite problem down here. We have not clearly strongly broken below the top of the range. We're not clearly in a bear trend. So selling below bear bars in the bottom third, buying above bull bars in the top third, it's not as high a probability as most traders want, and not many traders are doing it. Can you buy above 48, similar to buying above 30? 30, we had a head and shoulder stop, left shoulder, head, right shoulder. Bears had their stop above the right shoulder, and we got that breakout here. The bulls who did buy above 30, where the bears had to buy back their shorts, made a scalp. And you have the same thing here, lower high major trend reversal, decent sell signal bar, 49. A lot of the bears have stops, one tick above 48. Can you buy above 48? Arguing the bears will give up. I would not do it. I'm not going to do it. It's in the middle of a tight trading range, and there are not that many bears who sold below 49. So it's not like there are a lot of bears who are going to be buying back shorts above 48. Traders are mostly limit order trading, buying below, selling above. So not a lot of bears who are going to be buying back shorts above 48. Market's deciding, can it get above last week's high? Or are we going to stay around the open of the week for the remainder of the day? I think we're going to either go up or down and then come back to the open of the week at the end of the day. And the market right now is deciding, are we going to come up here and then down here, or are we going to get down to the low of the day and then come back to the open of the week? It's frustrating, everybody's here to trade, but you got to do what's appropriate for the chart in front of you. And I think most traders should just be waiting. You can call it a high one. You can think of this as a bull trend beginning with 41 and a high one above 45, not very good. High one above 51, not very good. There's a wedge, low 3, 1, 2, 3, but a bull bar, and still on the buy above 51. So I would not take that short. Math is very difficult here, so I think best choice, wait for it to change. Market's deciding are there more buyers or sellers below 52, and 50-50 chance. Very difficult to structure a profitable trade here. You can always be swing trading, short, stop above the high of the day, long stop below 41 or below the day. But I typically do not swing trade unless I think the market has begun a swing. So and there's no evidence of that yet. So it still looks like a tight trading range. Breakout mode. So either the bulls will try to get up here or the bears will try to get down there. You can see the bears got trapped there. For the bulls, this is a better buy than 51, but it's still not all that good because we're still in a tight trading range. The logic for the bulls is that we have a low 3, a wedge, lower high major trend reversal, and a 5-tick trap. And that increases the chances that the bulls might be able to get a breakout up here. Well, now we have 5 bars with exactly the same high in a tight trading range. That is a ledge. 80% chance 2 things will happen. We're going to go above the top of the ledge. We're going to pull back below the top of the ledge. Normally it happens the same day. Sometimes it happens a day or 2 later. So the bears still are on their wedge lower high major trend reversal below 52 or 53. And if we sell off today, then probably on Monday we'll come back above the top of this ledge. A ledge is 4 or more bars with in a tight trading range with exactly the same low for a ledge bottom and a ledge top. Let me scroll up. Ledge top is 4 or more bars in a tight range with exactly the same high. And 80% chance you'll break through the ledge and pull back below into the ledge. Ledge top, we sold off, we broke above it, and we pulled back below it. Sometimes it'll be a week or 2 later, broke above it, pull back below it. Broke above it, pull back below it. We have a ledge bottom, broke below it, pull back above it. Broke above it, broke below it. Broke above it and pulled back into it. Broke above it and reversed down. Here, look at all the bars. A 9-bar ledge, 9 bars, exactly the same price. Over here, about a week later, we went above it and pulled back below it. Whenever the market keeps touching the same price many times, I arbitrarily picked 4 times. The price is important and therefore a magnet. Similar to 39, outside down. You can see how difficult it is to structure a profitable trade other than limit order trades, buying below, selling above, scalping. Not a good environment for stop order traders. Are we always in one? We probably are. We've had a lot of closes above the moving average. Over the past 10 bars, we've only had 1 close below the moving average. Is it bearish enough to start selling at the market? Now we're still at the bottom of the trading range, 4-hour trading range, now 5-hour trading range. And also the open of the week. This is all about the buy climax on the daily chart. Traders are deciding, do we take profits? Is it exhaustive enough? Do we take profits and look to buy back down here? or can we get it above that December sell climax high and then take profits a little bit higher? Bear is trying to get a small double top. Here's the neckline, and then they try to get a measured move down. Minimum reversal will probably be at least a third of the rally, and the February low from last year is an obvious magnet. Bear is trying to get a reversal down. This is the SDS, which is basically an upside down equivalent of the E-mini. Bulls get a reversal, higher low, major trend reversal. No very good buy signal bar, but the possibility of a swing up, spike, pullback, and then maybe channel up. And this is the upside down version of the E-mini, basically. And for the bears, they have a spike down, a pullback, and they're hoping to get the start of a trend down here. Target low of the day and the 60-minute moving average. We're probably back to always in short, maybe with 60, 59, and then if 60 closes near its low, then probably always in short with 60. But we're still at the bottom of a tight trading range, and we keep testing the open of the week. Tested it from the bottom here, from above here, here, repeatedly. If 70 closes on its low, especially if it closes below 41, that would increase the chances of a swing down to the 60-minute moving average. Because it's a trading range day, can you buy the close of 60, betting that the bears will not get the follow-through bar? A lot of traders do that in trading range days. Anytime they see a big bull bar near the top, they sell, like 36 or 38, and a big bear bar near the bottom, they buy, like 23 or 40 or 41. So there will be some bulls buying the close, betting against the reversal. The more it closes on its low, the more likely we'll get at least a little bit more down. I am not terribly bearish. We're still testing the bottom of a trading range. And since the open, I talked about the open of the week being a magnet. And I still think we'll end up closing the day very close to the open of the week. See that tail? That's not good for the bears. So, the bears need bars closing on their lows. If they're going to get traders selling at the low of the day, especially at the low of a trading range day, they need to get better bars than that. Low one's short, but the bottom of a trading range. And for the bulls, they see it as a wedge, 1, 2, 3, or 1, 2, 3 different ways to draw it. But for them, it's a wedge bull flag, and they're looking for trend resumption up at the end of the day. For the bears, they have a lower high major trend reversal, but not a good sell signal bar, 56, 57, 58, and tails 59, 60, so not strongly bearish. So still unclear. Always in short, 60, right? It was always in short, 40. But trading range day, always in short, always in long, does not mean that much. Usually by the time the bears are strong enough to make it always in short, it's going to reverse up. And by the time it's clearly long, it's about ready to reverse down. That's the nature of trading range days. So you got to be looking for a reversal here. The bulls want a bull bar closing on its high. I don't think we're going to get a trend today. I think we're going to remain in a tight trading range. I've been saying all day that the open of the day would be a magnet all day, and it's been a much stronger magnet than I thought was likely. We've been in a very tight range, but it reduces the chances of trend resumption up. It reduces the chances of trend reversal down. It makes it more likely that we're going to stay right around this level. Limit order traders, They bought below 68, they bought below 50, they bought below 41, they bought below 61, and they'll all make money. So we should get back above that 68 low, above the 50 low, assuming this is still a trading range, which it appears to be. Outside up makes it a weaker buy signal bar. That's the buy, but not a high probability buy. For the bulls, a wedge bull flag. This happens a lot when you have a head and shoulders top. You get a bear breakout that looks like it fails, and only 40% chance you're going to get a swing down. So 60% chance it's either going to fail or we just continue sideways. Bears will try to get a low 2 below 63. Bulls trying to get the reversal up. Higher probability to buy after we see a reversal up. But even then, I think the math is very difficult. It's a limit order day. You know, buying below 50, buying below 41, buying below 61, better than buying above 62. I have to turn the screen off for a second. I'm trying to recreate this workspace on my other computer, and I want to see if there's some defect in this workspace. I've recreated this workspace before, but that was right after TradeStation 10 came out, and they may have done some things that have eliminated the problem with the trend lines. So I'm recreating the workspace again to see if the trend line problem is gone. For the bears, another lower high in a bear channel. We may get one more push down. When you see a breakout this strong, the odds are you get a small second leg down at a minimum. But this might be big enough to get 2 legs down. So 1, pullback 2, pullback 3 to a wedge bottom. So it's a credible short for a swing, but most of the bears will end up scalping somewhere below 60. The market's deciding, is it only going to be 2 legs down, 1 pullback 2, or is this a spike and channel pattern where we get 3 legs, 1 pullback 2, pullback 3? Unclear, right? Not clear at all. Certainly okay swing, but I think most traders who swing it, hoping for a trend, will end up scalping. I did not short it. This is a limit order market. Remember I said the bulls above the 55 low would make money. We went 1 tick above the 55 low and the 50 low and all these lows. So if the bears are strong, if this is going to be a swing down, they should not have allowed those bulls to make money. So that's a warning that we're probably not going to go very far down. And we may have seen the low of the day back here on the open. For the bears, we're testing the moving average. You can call it a low 2 with 64. You can call it a low 3 with 61. But a bull body, not a good stop entry sell below 66. And for the bulls, so far, not a particularly strong reversal up. So most traders better off just waiting. I'm going to turn the screen off for a moment. I'm going to see if I can transfer that. Other workspace over here. I'm just seeing if I made any mistakes on copying it over. I'm going to draw some trend lines and see what happens if I delete them. All right, so let me draw maybe a couple more in. And I'll just draw a couple random ones in. And now, let me see what happens if I try deleting a trend line. Oh, same problem. Okay, I'm clicking delete, and it's deleting some of the trend line. Remove trend line. It's removing some of the trend line. So it's still the same problem, even though it reconstructed the workspace. So there's a bug somewhere in TradeStation. The range here is so tight, it's even difficult for limit order traders. Also, we're in the final hour, and I think it becomes more dangerous for limit order traders. Is it always in long or short? I don't have a strong opinion other than we're at the bottom of a trading range day, and the bears did not do enough to make me think we're going down. However, the bulls have not done enough yet to make me think we're back to always in long. So you could argue we're still always in short based on this, but I'm not trading always in. I'm not swing trading. I'm currently flat. When the range is this tight, especially in the final hour, I don't want to be trading it. So deleting it, and it's deleting some other line. So I hit delete, and it deleted some other line before it deleted the correct line. Remove trend line, remove a different line. Remove trend line, it removed the right line. Bulls have a decent bar, 62. Trying to get another decent bar, bull bar closing on its high with a close at or above the moving average for a possible swing up. Bulls unable to get a decent buy signal bar. Bears trying to get a credible sell signal bar after the bulls failed a couple times to get a credible buy signal bar. But I think the math is difficult. You know, traders taking stop entry trades, they're hoping for swings, but they're sensing that every move is brief and they're scalping out. Limit order traders, they're having a pretty good day, but I think most traders should not be trading with limit orders. And this is, I think, too late in the day to be trading with limit orders, except in rare circumstances. Limit order trading is a high probability way to trade, especially if you can scale in. But this late in the day, it's easy to run out of time. It just takes the market to go a few bars against you, and then you've scaled into a full-size position and no time left to get out with a profit. If 71 closed on its low and did not trade below 68, I might have shorted it. So right now I'm waiting and trapped out. We're getting into that window, 12:30, 12:35, when the market often tries to have a trend up or down into the close. Is it sell the close? Not yet. I think the math is not good enough. Bears trying to get down to the, here's the low of the day, trying to get down to the 60-minute moving average. I talked earlier about how there was only a 20% chance when the market was here that we'd get to a new low of the day. But as you sell off, the probability becomes higher. So at this point, maybe 30 or 40, 50% chance we get a new low. And now maybe 50 or 60% chance we get a new low. And the bears close 73 near its low. If they can, then it's probably sell to close, taking a chance that we get down to the 60-minute moving average. What do I think the odds are? Less than 50-50. Remember, I said that this breakout might be strong enough for 3 legs down, 1 pullback, 2 pullback, 3. And the bulls will try to get a reversal back above the open of the week. Is there a sense of urgency, a sense that this is dropping quickly? There is not. There's a sense of hesitation and uncertainty. And uncertainty means confusion, and confusion favors trading range. So this is not, right now at least, a very good sell to close market. Spike in channel. This is what I was talking about earlier. That this might be a spike that could lead to 3 pushes down, not just a second push down. So you get a second push down, but this is strong enough to get a 3rd push down. This is a credible buy 74 if it closes on or near its high. That's the wedge buy. Is it a great trade? Obviously not, right? We're in a limit order market in a trading range day, but it's an okay trade to take a chance that we swing up toward the high of the day. Do I think we will? No. The bulls, though, probably will be able to make a scalp. And for the bears, I would get out of shorts. We have a wedge, we have a test of the low of the day, and a decent buy signal bar. On the other hand, if 75 is a big bull bar closing up here, bulls will be willing to hold on to see how far up it goes. pausing at 6 ticks tells you a lot of the bulls scalped for 1 point. Because it's a wedge, odds are 2 legs sideways, 2 up. Typically, the 2 legs will add up to about half as many bars as in the wedge. We do not have enough bars left today to do that. You need about 15 bars, 10 bars. So this is probably the first of 2 legs up. And if we opened around here on Monday, I would look for a second leg up on Monday. But realistically, we'll probably gap up a little, gap down a little, and the market will ignore all of this come Monday. This is not significant price action. Look where we are. We're right at the open of the week. I've been saying all day that the open of the week, especially in the final hour, could be an important magnet. The bulls want the bar 81 to close above the open to get a bull body on the weekly chart. But I don't think it matters all that much if there's a small bull body or a small bear body. Either way, it's not a very good buy signal bar for next week. It's an inside bar, which is good, but it's a doji bar and right below the 20-week moving average. So whether or not there's a bull body or a small bear body, there probably will be sellers not far above this week's high. So there's a bear channel, lower highs, lower lows, but 3 bull bars, probably buyers not far below 76, but too late in the day for me to take that buy. The E-mini today, I thought might close around the open early on because several factors. One is the week so far is an inside week, and we opened not far from the open of the day, not far from the open of the week. So that increases the chances that we would try to close there. Inside week increases the chances that the week would be neutral within last week's range. Not much incentive to go a lot higher. We already have a buy climax, 4 big weeks up, and stopping exactly at the moving average. The next significant resistance is up here, and we're not going to get there. So unlikely that we were going to go much higher. After 4 big bull bars, unlikely that we were going to get a big sell-off. So that left us with the day probably not going to go very far up or down. And since we were near the open of the week, it made sense that we would try to close around the open of the week. And the bulls would try to get a slight bull body, making it a slightly higher probability buy signal bar for next week. And the bears would want a small bear body, making bulls a little less willing to buy next week above this week's high. I don't think it matters. There probably are going to be sellers above this week's high. Next week, we might go up for a week or so, but that's probably it. We have 4 big bull bars, a buy climax, and we have a weak buy signal bar. This rally is strong enough to get a second leg up. However, we may only get maybe 1 bar up. For the bears, I think we're going to pull back for several weeks. But right now, it looks like we're probably going to go up next week and then possibly start to pull back the week after. Daily chart. We had a crash. The top of the crash, the top of the most recent sell climax is always a magnet. So there's a magnet at that December 12th high. But we have a parabolic wedge rally. 1 pullback, 2 pullback, 3 legs in a very tight bull channel. That's a buy climax. And usually bulls get exhausted and they start to sell out of their longs to take profits and then wait 10 bars or so before looking to buy again. And they don't have to do it exactly at this point. A lot of times you get a 4th, sometimes even a small 5th leg up before the bulls get exhausted and start to take profits. We have an important magnet here at the top of the crash, so we may have to get there before begin the correction down. Right now, the bears are hoping that we're getting a double top and that we'll correct down next week. Takes us back to that February low from last year. Let me me see if I have that drawn in. Yeah, I have it drawn in correctly. Here's the February low last year, and it's close to a 50% correction. Typically, when you get, well, let me say a couple of things about this. Back to the daily chart. Typically, when you get an abrupt reversal, you end up getting a major trend reversal. And while it's possible this is a higher low major trend reversal, I think it's probably not. I think we're going to need a better major trend reversal. And by a better major trend reversal, I mean more bars. So I think either we'll start to correct over the next couple of weeks, or we'll go up a little higher and then correct down for a few weeks and form a higher low. And at a minimum, I want the sell-off to correct about a third of the rally. And typically it corrects 50%. It might correct more because this was so extreme down. So let's say we go up somewhere around here next couple of weeks, and then we start to sell off toward the end of February. I would expect we can back to the February low of last year. That was the bottom of the trading range weekly chart. That was the bottom of the range. So I suspect we have to test it at a minimum. And will we test the December low? Right now, I think we probably will not get down to the December low. We might eventually get there, but in the next 2 or 3 months, I do not think we'll get all the way here. Some stocks will get new lows, but a lot of the stocks, the very strong stocks, look like this. And if we sell off down here, Apple, for example, will be at a new low, but Amazon will be a higher low, similar to E-mini. So I think we'll end up with a higher low somewhere in this area of 2,500 at some point in the next couple of months, and then a second leg up. So one pullback and then two, and we may stay in a trading range for a year or more. Say we gapped up on the open, but most of the days have been pretty quiet, and therefore you have to assume today would be pretty quiet as well. And with the parabolic wedge buy climax here on the daily chart, the bulls are probably exhausted. You can see the past 4 days, small days, bear days, not much energy, and not a very good high one bull flag, 3 consecutive bear bars. So probably not a lot of buyers above yesterday's high. And we broke above yesterday's high. It looks like a test of last week's high. So on the open, first bar of the day, a fairly big bear bar closing on or near its low. And I said it was a possible high of the day, but I thought the tail was a little too prominent and on the bottom. And I also thought we might try to get above last week's high. So I said, probably a limit order market. And then bar 2, a doji bar, not a very good looking buy. And then bar 4 is a second entry buy, but it's not even closing on its high. Bar 6 closed on or near its high. That was probably the first good stop entry buy. So above 6, above 7, above 8, above 9, maybe, but we have 6 bull bars. And 6 is something of a magic number in these buy to close rallies. A lot of times you get a pullback after 6. But I do think it was a reasonable buy the close bar, bar 9. You can buy the close, buy above its high. I think it's also okay to get out below 10 because of a wedge, 1, 2, 3. I think you can stay long. There probably are buyers below 10, and the bears will probably need a micro double top. They had a micro double top with 12, but a bull bar, so not a very good sell. And then we got that big doji outside bar 13 warning us that we're probably in a trading range. We have 5 sideways bars at that point, and we went down sharply, they bought it. Up sharply, they sold it. So it's telling us that even if the market falls quickly, they're going to buy it. Even if it rallies quickly, they're going to sell it, warning us that this might be converting into a trading range soon. 16, a decent bear bar, the third decent sell signal bar of the day, 1, 2, 3. So wedge, doji, magnet. So it's a reasonable candidate for the high of the day or for at least a swing down. Weak entry bar, 17, weak follow through 19. A second entry short, 20, but a bull body.
this does not look all that bearish. 3 bear bars, 22, but we're still above the moving average. So we're probably still always in long, even though we have a lot of bear bars. 24, another test of the open of the week, double bottom with 13. But a doji bar after 3 bear bars, not a very strong buy. It's a waste of time with TradeStation the way I have to keep readjusting the screen to show what I want to show. But anyway, double bottom 24, and then just small bars, prominent tails, reversals every 2 or 3 bars, trading range day. Much more of a limit order trade. Traders selling above bars, even with strong rallies, they sold above 16, and they buy below bars even with strong sell-offs. 39, 40, 41, they bought below 24 and below 13. So for the bulls, let me just talk about stop entry trades. First reasonable one was about 6, 7, 8, and 9 as well. It's probably okay. And the reason why I would not buy about 15 or 16 is third push up, and we might be getting a wedge top, which we did. The bears would sell below 16, and not really great sells below any of these other bear bars. Bulls, I would not buy above 24. I think you could probably buy above 26. You have 3 bars without a bear body, and then a higher probability buy above 35, a micro double bottom. You can call it a wedge, 1, 2, 3. Bull bar closing near its high. I said I would not buy above 38 at the time because I said top of a trading range, bear bar 37, big tail 36. I don't want to be buying at the top of a trading range. And then outside down 39. If you were quick, you could have sold below 39 or during 40. Tail on the bottom of 40, not good for the bears. And then 41 broke below 13, the bottom of the trading range, but also a big tail. The bulls, it's 2 legs down, 37 and 41, and a buy signal bar 42. Not all that great. I think this is enough of a surprise down so that we'll get a second leg down, and therefore this rally is probably a minor reversal up to a lower high. The bears are low 2 below 48, but I suspect we're going to get a third leg up. This reversal up is sharp enough, so 1, pull back 2, probably 3, and we did. And the bears did not get a very good sell signal bar, 53, 56. They got another one of these big bear outside bars. You can even call this an outside bar. 57, I call that an outside bar, even though its high is at the 56 high and not above. I still think of that as a variety of an outside bar. So we have outside, consecutive outside bars after a rally. So theoretically, it's a sell below 57, but I doubt we're going to go all that far down. With all of these prominent tails, this is not how strong trends begin. So, we'll probably test the 41 low and not get much lower. Micro double bottom, 62, decent bull bar, it's a buy. And then for the bears, low 2, 66 or low 3 with 61, 64, 66, but bull body. Second entry sell, 70 or 71 does not look good. And then the bulls have a wedge, bull flag 74, probably will get 2 legs up, but most traders were disappointed by the tail on the top of 75 and just scalped out. Always in. I thought we were always in long from probably bar 5 or 6, and I'd get out of longs below 10. And I definitely would get out of longs below 16 and short below 16. I think the bulls would get out of shorts maybe above 25 or 26. And you can see 27 is the give up bar. Bulls probably buy above 35. And I would get out below a bear bar 37 or 39. And the bears would sell below 39. I would get out above 42. And no really good buy up here, no really good sell. Next trade would probably be a buy above 62 and then a sell below 70, and a buy above the wedge, 74. Buy the close, sell the close, probably buy the close by the time we got 6. That's 5 bars up without a bear body, and now we have a bull bar closing on its high. So buy the close 6, 7, 8, 9, and even 10. Usually the first bear bar is buy the close as well. But realistically, I'm not going to be buying the 10 low. And up here, I would not buy. I would not sell here. I thought we were still always in long 20 gap bar buy. Up here with that tail, I'm not buying. And then here, I began talking to TradeStation for about an hour, and I missed selling 40, which is bad because you don't get a whole bunch of trading opportunities on a day like this. I prefer breakouts and stop entries, and that was a breakout. And I do take limit order trades as well, but to me, they're just not as fun. I don't enjoy them as much. And none of this is good buy or sell the close unless you treat it like a trading range day and do the opposite. So by opposite, what I mean is if you get a big bear bar near the bottom, instead of selling, you buy. If you get a big bull bar near the top, instead of buying, you sell. And I know that sounds bad or stupid, but it's not. That's exactly what you do in a trading range day. You bet that the trend traders are going to lose. So the bulls buying at the top, they're going to lose. The bears selling at the bottom, they're going to lose. And the market kept reminding us all day that the breakout traders were losing. The limit order traders made money all day. They bought below 1. I definitely would buy below 5, and not so much below 10, but probably below 12. And then selling above 18 was still on the short, but not very good follow through after the wedge top. Here, probably buyers below 30, but probably not going much higher. And here, I suspect buyers below 43, and probably sellers above the ledge. Would I sell it? I would not. Theoretically, it was a buy above 55. Here, buyers below 61. And then here, there's no way I'm buying this far up in a trading range day. And here, probably buyers below 76, but they never made their money. Actually, they did make their money. They made a point. You also had the aggressive limit order traders. They bought the 11 low. They started selling highs above 10, above 13, above 18, and then prior highs. They sold the 30 high, the 18 high, the high of the day. They bought the 33 low, the 24 low, the 13 low. They sold the 43 high, and then every high, 48 high. They bought every low, 55, 50, 45, 41. Then up here, they sold the 63 high. They bought the 65 low. They bought the 60 low. They bought the 73 low. And I know when I'm saying that, it sounds not real, but it is real. And on trading range day, years and years ago, when I was a lot younger and a lot more energetic, I would take a whole bunch of those trades. And now I take some of them, but for the most part, I like to wait for either stop entries or breakouts. I do take a lot of the limit order trades, the good ones, like 5 bars up, buying the 5 low, I tend to take that. Buying the 61 low, I tend to take trades like that. Excuse me, I'm losing my voice at the end of the day. Let me flip over and take a look at questions. Question, you said that you don't like to place limit orders in the last hour. What is the last time of the day that you would place a stop entry trade, which might require scaling in? Usually, same thing. I think of scaling in as a limit order type of trade. I do sometimes do it, and sometimes I'll take a limit order trade in the final 10 minutes, but it's rare, and especially with me talking, I do it much less often. But sometimes you'll have a day like this with just crazy reversals, and sometimes right at the end of the day. I'll take a limit order scalp for 1 or 2 points. But in general, I'm not willing to scale in, or I rarely scale in after 12 o'clock or 12:30. I sometimes do it. I did buy above 74, and I ended up scalping out for a point. If it went down, would I have scaled in? I don't know. I might have bought more below 74. I don't know. Probably not. With this wedge and a good buy signal there, I probably would not have. In general, I think most traders should not be thinking about scaling in, and they should not be thinking about limit orders. They should be thinking about stop order trades and either using the appropriate signal bar stop, like if you sell below 16, put a stop above 16. Most traders should do that. If they buy above 74, they put a stop below 74. Most traders should do that. However, you could use wide stops. Like if you sold below 10, it's possible to use maybe a 10-point stop and just hold on, and then maybe you get a second sell signal below 16. You sell more, and then you get out break even on the first sell when it gets back down there. Okay, question. Follow up to yesterday's question. In your third book, you suggest buying calls during a bull spike and a strong bull breakout, but during spike, you have to pay a huge volatility premium. If we go sideways for a day or two, the call price collapses. What's the deal with that? That's true. But we're probably talking about two different things. Let me show you what I mean. Okay. Here, for example, on the daily chart of the E-mini, it's strong enough. The context is really good, and it's a huge bull bar. Can I buy calls, or should I buy call spreads? I would not hesitate buying calls. In fact, I did buy calls early in that day. I talked about it in the room. I said I bought calls very early in that day. But I think you could buy calls there or here. And yes, the premium is really high. And then when it goes sideways to down for 4 days, the risk premium disappears really rapidly. But it depends on many things. What's your goal? Is it points? Is it, are you planning to hold for a day? Are you planning to hold for a week? Are you planning to hold for a month? If you're planning on holding for a month, I would not worry about the time decay, because, the rally, the potential rally, more than makes up for any time decay. And a lot of the time premium will come back as the market starts to go up. So, but if you're talking about buying at the top of a buy climax, let me put up, let me just get this out of the way, put up maybe a weekly chart, I'll put up square, like this, okay? This is a weekly chart of the E-mini, okay? Am I gonna buy calls right here? No, because this is so climactic, it's unsustainable. So typically, I'll buy a strong reversal up, even if it's very strong, climactic, but I'm less willing to buy a climax late in a bull trend. So this, I would not buy calls because too much risk of that. And this, on the other hand, at the start of a trend, if you get a very strong reversal up, I'm much more willing to buy calls. So that, at the start of a trend, especially after a climactic sell-off, I'm willing to buy calls despite the huge premium. I'm not willing to buy calls when the market is late in a trend and having a huge buy climax. If you want, one obvious way to handle the concern about high premium is to buy call spreads, so that you buy one call and you sell a higher strike call, and the premium you lose on the call that you bought, you make most of it back on the short call higher. I tend to trade outright option positions, buying puts and buying calls, more than spreads, but that's because I'm looking for quick moves. Sometimes I'll take a position thinking that I think it's going up, but it may take 2 or 3 weeks to go up. In that case, I'm much more interested in buying a spread. But if I think that it's so strongly up, it's going to go up soon, I'm probably just going to go ahead and buy a call. In general, I'm looking for option trades that I think are going to go happen very quickly. So most of my option trades are things that I expect to move within the next day or two. And if I'm buying a breakout, I'm buying early in the breakout, and I'm typically only buying an outright call, even though, based on your question, in the time decay issue, a spread is a safer way to trade it, especially if you're starting out and not willing to make a lot of decisions. Then the spread is the safer way to do it whenever volatility is high. But for me, I'm looking for really quick moves, and if the quick move is underway, I typically just buy the call and take profits either the same day if I get a windfall profit, or in a day or two if I get a very big quick profit. Please talk about why an outside bar is a bad signal bar. It's not a bad signal bar. It depends on context. And if I see a big doji bar like 13, I'm not going to be buying above its high, right? It's a bad buy signal bar. But if I see an outside bar, after a rally like this, we have consecutive outside bars. That is a reasonable signal bar. I talk about this every now and then, consecutive outside bars or signal bars. I have the GoToWebinar window covering a chunk of my screen, so it's hard to see. Okay, so sometimes you can get consecutive outside bars, and that's often a very good trade. So if the market's been selling off for 10 bars, 20 bars, and you get consecutive outside bars, and the second one closes on its high, to me that's a very good buy. Here's another example. We have an outside bar, we have a bigger outside bar, we're in a bear trend, I'm going to buy that. And here's the opposite. We have an outside up bar followed by an outside down bar closing on its low, I'm going to sell it. So if I'm looking to buy above an outside bar, I prefer it to be in a bear trend, and I prefer the bar to close near its high. And I especially prefer it to be consecutive outside bars. If I'm going to be selling below an outside bar and a bull trend, I prefer the bar to close near its low, and I especially prefer there to be an outside bar, because then you have trapped bulls who have to get out, and a lot of them will get out below a bear bar. So that's an example of consecutive outside bars. A single outside bar also is often a decent signal bar, depending on the context. So at the start of a bull trend, a lot of times you'll get an outside bar. At the start of a bear trend, you often get an outside down bar. So here we get a bear trend. We have an outside doji bar, but we have 3 bull bodies. To me, that's the buy above that outside bar. Here, outside up. Theoretically, that's a buy, but you have to be willing to put a stop all the way down here. So outside bars, if they close on their high or low, here's an outside down bar and a bull trend. So theoretically, that would be good enough. The bear's got a scalp, but not much more. My big reservation about outside bars is, if you think about it, it's totally overlapping the prior bar, and therefore it could be part of a tight trading range. And if you're in a tight trading range, you don't want to be buying at the top or selling at the bottom. So that's one of the problems with outside bars. Another one is they're often very big, so the risk is big. If you buy above a big outside bar, your stop is below the bottom, and if the bar is big, your stop is far and your risk is big. And very often it's an outside bar. It's consecutive bars, could be a tight trading range, and that is a magnet, and that lowers the probability for stop entry traders. And final question, can you explain why you would have bought below 76 had it been earlier in the day? Yeah, we have a wedge bottom, 1, 2, 3. Not a strongly bearish day. Trading range day, I'm looking for a reversal. Trading range days often reverse after 2 or 3 legs. And so to me, we got a reversal down and a very good buy signal bar. Wedge bottoms typically result in 2 legs up. And this is the first leg up, 3 consecutive bull bars. And therefore, there should be buyers below 76, stop below 74, and we should get a second leg up. We may go sideways for 5 or 10 bars first, but chances are we're going higher. So if it was earlier in the day, or if today had more trending behavior in it, I would be more willing to buy below 76, even in the final hour. But this is very close to 1 o'clock. I'm just about to talk. If I were not talking, I probably would have bought the 76 low, put a stop below 74, bought more, a point or 2 lower, and scalped out. Okay, hope everybody has a good weekend. This week is a buy signal bar for next week, but not a very good looking one. I think we're going to go higher, but probably not more than a week or 2 higher, and then start to go sideways to down for a few weeks. Okay, hope everybody has a good night.